We are in the third module. There are two chapters. The first one we just finished, we talk about fiscal policy. Now this is the second one, we talk about monetary policy. But what is fiscal policy and monetary income? Both are trying to affect aggregate demand. From there, you can see that is essentially following Keynes's view. Right? But they are different in terms of how they are going to affect the aggregate demand. Fiscal policy affects aggregate demand through changing tax, government spending, or transfer. But for monetary policy, so they are going to through changing money supply and the interest rate. To understand how this monetary policy really works, we have a few concepts we need to understand. What is money supply? But what is money in the first place, right? And the interest rate. So how does money supply related with interest rate? How the central bank can adjust interest rate? How changing interest rate affect our aggregate demand? Right, so those are the questions we will study in this last chapter. Now let's start with the money. Right, what is the money? First of all, money plays a central role in modern economy. We really cannot live without money. But this money, you need to think in a very general way. Okay, for sure, like many things are considered money without a notice. First of all, the cash you use is money. Your credit card is part of money. Your debit card is part of money. Right? So those all are money. But now let's see, so what is actually defined as money? Money is defined as any assets that are easily used to purchase goods and service. So in this definition, there are three things I want to highlight. Since number one, it is assets. It's like a financial assets. Number two, what is the purpose of using these assets? So we want to use these to do our trade, right? To purchase goods and service, to facilitate the transaction. And number three, this something must be easily used. But this here, so this easily used, meaning you can measure things, meaning you can keep it, meaning is convenient for transportation. Like say, for example, you want to do some long distance travel, trade or business, right? So this is what this easily means. But the main thing is that, so this is assets used to facilitate transaction. So in history, so we have seen different forms of money. I mean, as a starter, let's show you two examples. On the left-hand side is something recent, 1933, after the bank failures. That's in the worst day of the Great Depression. Right, so financial market kind of collapsed. People lost their confidence in the government, the central bank, and some citizens. I mean, people in this small town in California, they decide to use this clamshell on the left-hand side as money. Again, so essentially they just use this for their transaction. So they trust these, they agree with each other, we're going to use this for our transaction. On the right-hand side, this is in a more ancient day, this has been used for hundreds of years at different countries or different civilizations. So basically, similar things, right, but in different contexts. Right? These are two examples. It's quite different from the money we are using today, but these essentially serve as the purpose, which is facilitate transaction. Right. Now I'm going to throw you with a few concepts, and then so I'm going to give you a little bit detailed discussion regarding to what is money. Currency in circulation. This includes cash held by the public. If you just look at your wallet, you may have some paper bills, and in your car, you may have some coins. So those are currency in circulation that is held by the public. Right? And furthermore, this is not currency like say, for example, you have some currency for collection. That's different purpose, right? So this is the currency in circulation. Now the second concept is called checkable bank deposit. If you ever have a bank account, you have a checking account versus saving account. For checking accounts, you can just freely use, right? Either write a check or you just use your debit card to buy goods. or you can withdraw cash without any notice, right? So you can, with your debit card, you can go any grocery store, just has cashback, right? So no cost. Okay, this is a checkable bank deposit. Now this goes to the money supply. What's the money supply? It's the total value of financial assets that are considered as money. So as I'm going to show you later, currency in circulation and currency in circulation and checkable bank deposit is the most narrow definition of money. But I guess here still is a little bit broader than you thought, right? So before you take my class, usually people think currency in your circulation, that's money, or the money supply. Actually, money supply also includes checkable bank deposit. And in terms of size, checkable bank deposit is almost 10 times, or in that scale, compared with currency in circulation. And then later in this chapter, you're going to see how this checkable bank deposit and why it is considered as money and how this money supply is going to generate. So this is what we're going to study later. But for now, let's focus on 3 simple concepts. Number 1, currency in circulation, which essentially is the cash you have. Number 2, checkable bank deposit. Number 3, money supply. So money supply essentially is the summation of these first 2. But certainly we have more broader definition of money supply. Like the more broader definition may include your money in your saving account. All right. Money. Formally, in order to be considered as money, this financial asset has the ability to serve the following 3 functions. These functions include medium of exchange, actually that's key, store of value, and unit of account. So this last 2 is kind of related to easily used, as I mentioned earlier, right? It is a store of value, so that's easy use, so you can keep your value from one period to another period, or from today to future. Unit of account, so that's kind of help you to measure. But the key function of money is medium exchange. It's something everyone agree. We accept that as exchange, we get goods and service you need. Just imagine without money, how we are going to do trade. Before we have money, we have trade through barter. What that means is, so I have a phone, I want to have salt. What am I going to do? I need to find out someone who have salt but need a phone. If that's not the case, and then I need to go to somebody else so that I can exchange something the person who has salt need. Right? You can see this is very tedious. Now, money is going to resolve that issue because this is something everyone agreed to take, even though this person may not like the goods I have. What I can do is I can sell my phone and then use the cash and then buy the salt. So that's solve the issue. This is medium exchange. Right? So immediate exchange is defined as something people accept as payment for goods and service. So the purpose is to do transaction. Now, store value just help you to hold in the purchasing power from time to time or across time. And finally, so the unit account essentially just provide a yardstick so you can measure in the value of different amount of different goods, right? So in some sense, you need something divisible, right? So those are the 3 things. Those are the 3 things money must serve, and the 3 functions money must serve. Now let's look at the history of money. So the first type of money emerged in human history is called commodity money. So this is the goods itself has intrinsic value. But then so people agree, so we can use this as a medium exchange. Here are 2 examples. On the left-hand side of this slide, and it's on the bottom, so the picture shows some people under some very special circumstance, they decide to use cigarette as currency. On the right-hand side, in some location, some like a remote island, and people agree to use this round stone. I don't know what it's called. So they agree to use that as currency. But clearly you can see these two things are very inconvenient or not easily to use, both in terms of value or in terms of transportation. But that also explains, so with the advancement of the human society, we move to the next stage. So what is commodity-backed money? Again, this is the money. It needs to serve those three functions we just talked about. Number one. But instead of commodity itself, this is commodity backed. That's the key. Okay. So what that means? It means, first of all, the money itself has no intrinsic value. That's different from, for example, you have gold. You use silver as money. All right? But this thing has some commodity to support. Now let's take a closer examination at this piece of paper. Let's take a closer examination. So this was print, I cannot find, maybe like 18 something, right? This is in the United States. Now, what I want you to pay attention, just look at here. This is payable to the bearers on demand. And so basically it says, so if you have this piece of paper, you go to any legal bank. Okay, so they are responsible to exchange to certain amount of silver. All right, so this is $1, so they are going to give you certain amount of silver. But that's not the case of the currency we are going to have today, right? So today, so with this piece of paper, so they're not going to guarantee give you certain amount of silver or gold. But for this piece of paper, it's guaranteed, so you can get exchange with certain amount of silver. Or in other words, so the status, the status of this piece of paper as money, or quote unquote, its value, because it itself has no value, just piece of paper, right? To print these even 100 years ago, it probably just cost almost nothing, not to mention today, right? So to print this piece of paper or to make this piece of paper, the cost is almost zero. Or in other words, this piece of paper itself has zero intrinsic value. But where is value derived from, or where does its status as a medium exchange come from? It's coming from this sentence, coming from the facts there are certain amount of silver or a certain amount of precious gold, or in general, certain amount of commodity is at your disposal whenever you want. Right? So this is commodity-backed money. Now, compared to the commodity money, what is the benefit? And then furthermore, compared to the next stage, or in other words, what is the shortcoming of this type of money? Let's start with the benefit. Compared to commodity money, what is the benefit of this one?
Easier to transport.
Easier to transport. Right? So I guess that's the main benefit. You don't worry about like transportation, like for long distance, right? And maybe the other thing is, so this one you can make it like uniform, right? So because this manufacturer, okay, so that's the benefit. Now, what is a potential downside of commodity-backed money? But certainly, this is something inherently exists with commodity money. Maybe just go back. Commodity money, besides the shortcoming of not easy to transport, not easy to keep its value, what else? Give you a hint in terms of supply. Yeah.
You can't adjust the supply easily.
You have to manufacture, right? If it's like a gold, you need to what? You need to get from the natural. So it's going to lengthy process, right? And it's similar here, because for each piece of paper, it's going to guarantee to buy certain amount of commodity. And then so inherently, so this commodity backed money is going to carry the shortcoming of the commodity money, right? But then, so why we cares about that? Now to give you a hint, economic growth. So if example, economy size grow by 100% from one decade to the other decade. So if we use commodity money, what would be the problem? So you don't, yes.
To prevent inflation or to prevent deflation, you have to keep making new commodity money.
Right.
But that requires getting more of
Right.
the commodity or aligned about how much.
Right. So essentially, so you don't have enough unit of count to facilitate your transaction, right? So the only way you can do is keep making those commodity. But unfortunately, so as we just realized, so the production of those commodity becomes harder and harder. Just think about what happens in 1950, 1960. Because before that, the US or like after World War II, so we agreed to use this like gold back, but the gold supply is limited. And a particular thing about if the economy growing extremely fast, right? Okay, so this is the benefit and the problem of a commodity backed money. Certainly, this is a huge advancement. This is significant different from the commodity money, right? But this naturally goes through the third type, which is fiat money. What is fiat money? On the surface, I mean, in terms of the form, it's pretty much like what I just showed you earlier. But instead, there's one sentence was ripped off from the piece of paper. Which sentence? Let's go back. This one, right? This sentence. This sentence says, okay, if you have this piece of paper, it's guaranteed it's payable to you with certain amount of silver. Right? So this is interesting, all right? So this is very interesting. Here I want to highlight it. What's the interesting part? But today, if you have $100, yes, in the market, you still can get a certain amount of silver and gold, right? But how much or how many gold and the silver you're going to get is going to depend on what? The market, the price, right? But in this case, how much silver and gold is going to get? It's going to determine by what? Actually, literally is print on this piece of paper, meaning whoever provide this piece of paper. In old days, like commercial bank, they can print, they can issue money, right? So that's whenever they decide to issue this piece of paper, it's already locked with certain amount of gold or silver. That's different from fiat money, because fiat money, so I mean, how many gold and silver you want to get is not a guarantee. It's going to determine by the market, right? All right, to summarize, what's fiat money? It's just a piece of paper, has no value. But then, so where does its status come from? Or why people trust this piece of paper? The difference from commodity money is why people trust commodity money is because this is a evidence, right? So like a contract. So you can get a certain amount of precious gold or precious silver or commodity, right? Now here, but this piece of paper, if you have that in your wallet, why you trust that piece of paper? Why? Where your confidence come from? So that's the key. We understand fiat money. So why you trust this piece of paper? It's useless, you know. What you can use that for? Why? So this is backed by the government. So look at it here. So there's a signature by the treasury. Right? So this is backed by the government. Essentially, this is like a written in your constitution or law, says it has some official status. Or in other words, everything was derived from our confidence on the government. So in that sense, this is quote unquote like an illusion. What happens, the government is not responsible. But here we just assume the government is responsible. We assume the government is going to long live. Right? So that's where the value coming from. But this is called fiat money. Now, if you compare fiat money with commodity-backed money, what is the main advantage? What's a big step forward? There's nothing to constrain how much you can print, except the reputation. What's the reputation? What's the cost if I print too much money? What is the cost? Okay, let me say it again. What is the cost if US central bank, or literally just treasury, so they can, in some sense, at some point, they kind of can collaborate, but in principle, so they are not. Or in theory, they're not. But in practice, somehow they are. But anyway, so if, let's just use a very loose term, US government print out like 100 trillions of greenback, this piece of paper. Is there a cost to them? Is there a cost? Otherwise, why not they do just doing that? Like right now, so we talk about debt ceiling, right? So yesterday, if you ever watch the news, so Janet Yellen, so she's treasury, she's the secretary of the Treasury Department. She said that the US government is probably going to default as soon as June 1st. Have you guys paid attention to that news? So like I mentioned, 2 weeks ago, so KTV was interviewing me about the debt ceiling. So essentially, so once we hit the debt ceiling, and then the US government cannot borrow, just think about yourself. You are just imagine yourself, you're traveling in the middle of nowhere. You don't have cash, you don't have a credit card, right? And now, so you are desperately looking for food, very expensive. The only way for you to pay is your credit card. But now, unfortunately, your credit company says, okay, so you already reached your credit limit. What are you going to do? Is that a disaster to you or not? It is, right? So this is something US government is facing now. So basically, Congress or Senate told them, so I'm sorry, so you run out of your limit. You cannot borrow. But they have plenty of things they need to spend. Like, say, for example, they need to pay the Social Security. They need to pay Medicare. They need to pay like poverty nurses, so on and so forth, trillions of dollars. But unfortunately, they cannot. But then suddenly, so that's why I'm trying to explain to here, trying to explain to you. But they can print out money, you know. Why?
The Treasury is only allowed to print money when the Federal Reserve orders it, and the Federal Reserve is independent.
Right, okay, so that's fine. So that's exactly what I'm trying to say. So in some sense, they can collaborate. Right, so but even though so they can collaborate, so the Federal Reserve and not necessarily want to print money. Why? So that's just the question I had for you in the beginning. So what's the cost if Federal Reserve decide to print out 100 whatever trillions of dollars? What is the cost? Inflation. Right? Like in the worst case scenario, so everyone's going to abandon US dollar. Start from international. Right? And then it goes domestic. Does it make sense? So it's like, okay, so it's like a credit card company, like for your individual case, right? So if you just keep spending, so without any discipline, and then so the credit card company is going to stop issuing any credit for you. So that's kind of the similar situation. All right. So to summarize, fiat money, that's just kind of the optimal form of money, right? So there's no limit, but certainly there's some intrinsic limit, which is your reputation cost. Because at the end, we just running like inflation, and then so you are going to at the risk of losing the ability to issue money. Just remember what happened in 1930 in California. People not using US dollar. It happened, right? So, and right now it's happening in some other part of the world, like Zimbabwe, right? Okay, so let's just mention a little bit about why people suddenly. What do you think? What is the drawback of this fiat money? What is the drawback of fiat money? And why? So as far as you understand, why people interested in this Bitcoin or like cryptocurrency? As far as you guys heard about. Yeah.
I mean, this probably isn't the answer you're looking for. Most people I see online are interested in Bitcoin either for speculation or so they can buy heroin online without getting arrested.
All right. So and then we go to the second part. Essentially, so this remember this money is issued by a central bank, right? Yes. Okay. So you can just do your transaction like secretly, but here's a number. Everything can trace back, but not Bitcoin, right? But certainly, so this privacy or this like decentralization has its value and has its cost, right? So here, that's all I want to talk about, right? So let's stop here. All right, so now let's just go to these slides. Let's spend 1 minute, think about what would the economy be different if we use only local currency. So here, this local currency means like people live in West Omaha, they're going to use something different from people live in Papillion. People live in Papillion is going to use something different from people living across the border, across the street, no, across the river, who live in Council Block. If that's the case, how would our economy different? Just imagine what would happen. Whenever you travel from your home, okay, so in the morning, so in your neighborhood, you use one currency. Now you come to your Omaha, and the campus, we use different currency. How the economy is going to be different? So that's this question asking you. But certainly, this is an exaggerated version of international trade, right? And clearly, so there's going to be lots of transaction costs, right? So if you ever have experience travel internationally and you knew what the pain it is, right? So you need to convert the currency, and then you always have some left over, right? And that's over time, it's going to lose your value, and then so it becomes a piece of waste paper, and that's essentially the transaction cost, right? All right, so summarize. So this is like local currency or just two localized currency is going to add transaction costs, or in other words, so this currency, like unified currency, is going to reduce transaction costs. So that explains why in Europe, many European countries decide to join Euro. Because beside that, so before that, they use different currency, like France, they use franc, right? And Spanish, they have different currency, and so on and so forth. Now with one unified euro, and then the transaction becomes much easier and much fluid, right? All right, so now let's look at some definition. So this is going to be something very important, and keep track by central bank, right? Monetary aggregate. This is the overall measure of the money supply. And depending on how broad we want, there are different definition of money supply. So here in class, I'm going to explain to you two types, M1 versus M2. So essentially, So one is narrow, the other is more broad. Okay. Let's skip this. Let's look at here. Limit 1, M2. On the left side is M1. So that's the core definition of money supply. All right. M2 include M1 is broader definition of money supply. And in reality, we have M3, M4. So now let's see what is M1. M1 primarily including two parts. Currency in circulation. So that essentially that's the cash you have in your wallet. The cash you keep at home, right, for emergency, or some like illegal drug dealer. So they use this cash for their wills or whatever reason, right? So this is currency in circulation. Now the other one is checkable bank deposit. So essentially it's the money you have in your checking account, right? Oh, by the way, speaking of currency in circulation, so let me just give you a fun fact. What is the most valuable single currency? I mean, in terms of one piece. What's the most valuable one? Can you think of? For the US dollar, so the most expensive one is $100, right? So euro, what is the most expensive one? Does anyone have any idea? It's 500. But there's something more expensive than that. And then does anyone know? It's 1,000 Swiss franc. 1,000 Swiss franc right now is a little bit more expensive than 1,000 US dollar. So that's the most expensive one, as far as I knew. I mean, it's in terms of the value. Because on the face value, as I'm going to show you later, Zimbabwe, so they have currency. And the face value is like 100 trillion, but the actual value is 20 to 30 US dollar, right? This is M1. Now look at M2. M2 including M1, like a quarter. And on top of that, also including saving deposit, is the money in your saving account. It is compared with checking account, it's less liquid. But right now, in modern days, it's fairly liquid, right? So if you ever have experience transfer your money from saving account to checking account, you know how easy it is. Can anyone explain to you how you can use the money in saving account? What do you need to do right now? Does anyone have a saving account? Yes, if you want to use your money in saving account to pay saving account grocery, what do you need? What you must do? What are the steps you need to take? You need to transfer money from saving account to checking account, right? And usually how you achieve that? Use the app, right? That's what you do, right? And it's going to take like just a second, instantaneously you can use the money, right? Okay, 10 or 20 years ago, when I was a graduate student, that's not this case. So when I was a graduate student or at your age, I have saving account and checking account. In order to use my money in saving account, literally I need to call the bank or do something, a request. And then the bank is going to transfer my money from saving account to checking account, usually take 1 business day. And after that, I can use my money in checking account. But here you can see, so saving deposit is slightly less liquid compared with saving account, checking account, right? But in either case, so they are fairly liquid, okay? So now M2 include M1, as I just explained to you. You can see, so they are very liquid, meaning so you can use anytime. And then, so includes saving deposit, less liquid, just a little less liquid. And then so you have time deposit, meaning so you have fixed saving term, like 6 months or a year. And then so you have money in market fund. What is that? So if any of you have any invest in stock market, So for example, TD Ameritrade or Fidelity, right? Then means you usually just put your money over there, right? And then so their money there, and then to get investing stocks. So that's the money market fund, right? So in order to use that money, first you need to wire the money to the bank. But certainly, so in modern day, this brokerage, meaning like TD Ameritrade or Fidelity, makes things very fluid. They also issue debit card, right? In any case, so those are two definitions of money aggregate. Just tells us the size of money supply in our economy, right? So this size of money supply is going to help us to determine or help the Federal Reserve Bank determine the interest rate. But the interest rate, that's the key. Okay, interest rate, that's the key. Right. So this is the definition of M1 and M2. So those are the things you must pay attention to. Now let's look at this practice question. Which of the following assets would you classify as being most liquid? To understand what's liquid, let's look at C, your home, or you have a house. It is assets. So in theory, so they can give you value and can use that to do some purchase, right? But that's not liquid. Why? Because usually in order to use value in your house to buy some other stuff, what do you need to do? You need to sell, right? To sell the house, even though right now the market is hot, still take days, not months, right? So it's not liquid. What about gold? Is gold a liquid? Not anymore. Can you use gold to buy stuff in Best Buy? No. In order to use gold to buy stuff, what do you need to do? You need cash in, right? So you need to sell your gold. So they are not liquid. Now A and B, so what's the difference? What's demand deposit? This is just like your checking account. You can use anytime. What is small time deposit? Just think about you have a 3 months fixed saving or 6 months. That's small time. Hence, answer is. What's the answer? Which one do you think is the most liquid? A, right? So A. Thank you. All right. So now we have a basic idea. What is money? What is the total size of money supply? But the interesting part is, if we look at money supply, okay, if we look at money supply, let's go back to this slide. So the currency, even we look at the narrow definition of money supply, the currency is less than half of the money supply. But first of all, who controls this currency in circulation? As far as you know, so at the moment.
The Fed.
Fed, central bank, right? So in the United States, it's Fed. In UK, it's Bank of England, right? And in Canada, it's Bank of Canada, and so on and so forth. There's a central bank, so they just determine how much currency they're going to print. They're going to put in the economy. But now look at here. The size of the money supply is much bigger than the currency or something the Fed can directly control. If you look at M1, it's even, sorry, M2 is even larger. But then, so there's a question. Where are those money supply coming from? Because the Fed, if you look at this picture on the right-hand side, Fed only directly control 10%, right? Look at it here. Look at it here carefully, okay? So Fed only directly control 10% of the money supply. But where does the rest of 90% come from? And these are very important questions. Why is it important? So this is going to help us understand number one, what are the risks in our financial system? Number two, how Fed can affect the aggregate demand. Right, so there are these two important questions. Right, but in any case, what are we going to discuss now is to understand. So if the Fed is something like technically give you $1, okay, which is a currency in circulation. But by looking at these two pictures, why suddenly in our real economy, there are $10 you can treat as money, or you can use that for trade goods and service. Okay, this is the first sense. And after that, we are going to understand what are the issues or how the Fed can affect the financial market. Okay. So here's the questions. How unwinds currency? Where does the rest of money come from? Answer is the bank is going to create money. Or in other words, the financial system is going to create money. But then, so the next question is, what are the potential problems with this financial system in the process of creating money? Right. All right. So first, we need to understand the business model of bank. Right. So the business model of the bank essentially is work as a middleman, work as a bridge. Just imagine you have a project, okay, and it's going to become very profitable, but you don't have money. What are you going to do without a bank? If you have a project, so for example, just make the calculation simple. You need to start with like $1 million to start with the project. If there's no bank, what are you going to do? Okay, so one million probably too much if there's no bank. Let's say for example, so if you have a project, you need $1,000. You are like, just imagine you are like poor college student or poor high school student. You don't have no cash. What are you gonna do? $1,000. You need to ask your friends, your family, right? Whoever is willing to lend to you, right? But then, so clearly there's some risk. Not everyone willing to lend to you. Does that make sense? Because to everyone, all the failure is like hop and hop, right? So in that sense, so without a bank, without this financial system, even though you have brilliant ideas without the money, so most likely your idea is not going to realize because you do not have the seed fund. Does it make sense? So now let's see how the bank is going to solve the problem. So basically, bank is going to working like a pool. So how the bank works, or in a very abstract way, the business model of the bank is all goes as follows. They attract deposit. Okay, so they attract a lot of deposit and promise to pay you a fixed interest rate. Now, with this pot of money, they are going to lend to different projects. Like say, from the example I just give to you, someone came to me with $1,000 project, right? Look at that particular case. If odd of succeeds is 50%, meaning if indeed so this project fail, I'm going to lose all of my money, right? But now, say for example, for the bank, if I have a $1 million, and then so how many projects I can finance? I have $1 million. Like each project is $1,000. Maybe you can write down so it just help you to understand the math. But I think that's important. Okay, if there's one project, the cost of this project is $1,000, right? If its cost is $1,000, and the odds of success is 0.5 versus 0.5. This is with one project. Meaning, so how 50% of a chance. So these things are going to give me, like if we succeed, it's give me like, say, for example, $2,000. If fail, that's going to give me $0. So this is like a single project, right? So just tell me, so how willingly, how likely are you going to fund this project? It's very low, right? Okay, so now just think about the bank. So the bank, say for example, the bank has $1 million, meaning they can find 1,000 of this type of project, right? And then mathematically think about, so then what's odd? All of those projects are going to fail. It's almost zero, right? And so what is the chance of you making some money from out of this 1,000? Compared with this one, compared to the one, so like 1,000 versus this one. So the chance of making profit from this 1,000 is much higher than from only one project. Right, so there's some like sort of mathematics, but essentially the idea is the bank, so they can pool these risks together. But for you, you only have one project, so the chance is 50-50. But if you have 1,000 projects of finance, just think of an extreme case, all those projects fails, the chance is what? Is 0.5 raised to the power of 1,000, which is zero literally. Does it make sense? Just think about extreme case, right? So hence, so the bank, so basically, so what they did is, so they're going to collect the deposit, and then use the deposit, they're going to lend to many different projects. And why they lend to many different projects? First of all, they have the resource. They can finance to different projects. Second is by finance to different projects, so the chance of losing is much smaller. All right? Okay. So this is bank. Now let's see, so how bank create money supply. Because the next step is to understand the accounting system for the bank. So this is called a T account. You probably have seen from your accounting class. For each business, they have assets and a liability, right? So assets is what you own, and liabilities is what you owe. So like for the bank, their liability is deposit. So essentially, this is something the saver lend to the bank. If you just deposit $1,000 to First National Bank, so essentially, literally, you lend $1,000 to First National Bank, right? Okay, so but with this deposit, what the bank is going to do, so they're not going to sit on the cash. They want to make profit. Otherwise, how they're going to pay for the interest? Otherwise, how they're going to make profit? Right. So usually they are going to lend out, usually at a higher rate. And why is higher rate? This rate actually just reflects the risk. So make sure they're going to break even. And furthermore, there's a reserve. Okay, what is reserve? So essentially, this is the money they must set aside. But that's why there's a reserve. That's just in case the bank fails. They have some cash to pay off some of the deposit or pay the deposit by some fraction. Okay, so this is called reserve. This is called reserve. Just imagine if the reserve is zero. If the reserve is zero. And then, so what would happen if some of the customer need cash? They're not going to get cash, right? So that's why there's another way to understand so why they need reserve. But we are going to talk about that more in a little bit more details when we talk about the central bank. Now let's focus on the commercial bank. Okay, so understand the liability is a deposit, assets is a loan. So essentially, just lend out like a mortgage or like a small business loans. Okay. This is called T account. All right. And here we also have reserve ratio. That's a fraction of the bank deposit. The bank must hold as a reserve. Okay. I'm going to explain to you a little bit more why there's a reserve. But for now, so the easy way to understand is it's a minimum. So they need a reserve just in case the clients need cash. Right. Okay. All right, so the bank just work as a middleman, right? So now let's see how this middleman can create money supply. Actually, this is another time we look at multiplier. Just look at this case study. I mean, this think about a story. Okay? Just imagine there's individual Silas, or you can think about this is yourself. Silas used to keep a shoebox full of cash under his bed. Now he decided to deposit his cash or his saving in the bank. Now, how would that affect money supply? Now let's see. So what's the magic? Okay. So initially, so before the bank makes new loans, what happened? So basically, this $1,000 of cash becomes $1,000 of a checkable deposit. So basically, the money just changed the location from Silas' shoes box to where? To the bank. That's it, right? So before the bank do anything, what's going to be the total money supply? Just think about that's the only person, that's the only bank. What is the total money supply right now? Think about M1. M1 includes what? What does M1 include? Cash in circulation. What else? Checkable deposit. So before Silas walked into the bank, what was the total money supply? 1,000. Bank has nothing. Silas has all the cash, 1,000. Now, after Silas walked in the bank and after he left the bank with a card, what's the total money supply? First of all, what is the cash in circulation? 0. What is the checkable deposit? 1,000. So what is the total money supply? 1,000. So that's before bank do anything. But do you think the bank is going to do nothing? No, right? So this is not how they survive. What are they going to do? So the bank is going to make some loans. But remember, there's a reserve ratio. Let's take that for given, okay? So there's a reason why there's a reserve ratio. Now, saving them also, the law says the bank, you must keep 10%, at least 10%. First of all, how much loan the bank is going to make? 90% or 80%? Just think about yourself. You are the bank. You have $1,000 new cash. The law says you must keep at least $100. Okay, let me explain to you why later, not just take that for as a law. You have to keep $100. Now, the first question is, so if the bank decides to make some loans, do you think it's going to make 900 loans or 800 loans or 500 loans? 900, why? They're going to get more interest, right? So the obvious. Okay, so 900 loans. So now 900 loans. What this means? So first, that just means, okay, if the loan make out immediately, okay, so their reserve is going to reduce by 900 because there's lend out, right? But the loan is going to increase, meaning so the asset side is just break even. Okay, but that's not the end of the story. Now the next step is somebody. Now let's look at it here. This is where we start, right? So now somebody is going to take this loan, like in this case, Maya, right? So Maya, say for example, so this is a person who walk into this bank and take a loan of $900. Now just look at the second stage. What is the total money supply? And in what form? Again, you think about money in circulation and checkable deposit. So there are two individuals now in the economy, right? Silas and Maya. Silas, what he has? What does Silas have? What he has? 1,000 deposit. What does Maya have? 900 what?
Stylus money.
Or cash, right? So Maya has $900 of cash. Right, so now what is the total money supply? 1,900. All right, so you can see immediately generate 1,900. So this generate 900. Now Maya with $900 of cash, what she's going to do? Is she just keep the cash at the house and as a decoration, or just look at the cash and derive utility? That's not the purpose of the first place she walk into the bank, right? Usually, so she take a loan to have some business to do. Does that make sense? There's no reason she's going to keep that as cash, right? So she's going to do something similar to Silas. Now go to the third stage, right? So she's going to create a bank and pay whatever she need to pay, right? And then so the bank with 900 and those going to lend out 810. Does that make sense? So again, so this 1,900 is included 1,000 by Silas and 900 by Maya. So this is the total checkable bank deposit, right? Now Maya, so she has $900 in the bank, and then the bank is do the same thing, is going to lend out something, and eventually this is going to lend to the fourth or third or fifth person. Now you can see, so the bank start to generate money supply. All right. Then there are a couple of questions. First of all, what determines the size of this money supply? What do you think is the key things that determine the size of money supply? Just look at this picture. What do you think? Let's give you a hint. If this 900 becomes 800, so this money supply is getting larger or smaller? Smaller. If this 900 becomes like a 1,000, it's getting larger and smaller. It's going to become infinity. So as you can see, so here the key thing is this ratio, right? Reserve ratio. And then basically smaller the reserve ratio, the bigger the bank to generate money. The higher the reserve ratio, the lower the ability for the bank to generate money, right? Now, we go to a very interesting part. But why the reserve ratio is as it is? Why we don't make the reserve ratio as low as possible? It must be there's a cost, right? But what is the cost? Just think, but you look at this picture, what are the potential costs? If the reserve ratio goes to close to zero. Let me just give you an example, okay? Just look at this simple example. Silas keep his money in the bank, right? Because he doesn't need the bank now. Not just imagine in a month, Silas has an emergency and he needs the cash to do some surgery, otherwise he's gonna die. Now if the reserve ratio goes to zero, meaning so the bank lend out the money, right? Meaning they have no cash, right? But now, so if Silas desperately need the cash. First of all, walk into the bank, what the bank has. If the reserve, just look at it here, just if the reserve ratio is 90%. So how much cash the bank has? 100. But Silas desperately need $1,000 to pay for the surgery. And there's potentially what the bank can do. Okay, look at here. So what are the assets the bank has? Besides $100 cash, what else the bank has? Loans. What else? So in order to satisfy the need of Silas, what the bank can do?
They could sell their loans to another bank.
Okay, so that's the second step. So you are smarter than me. So first, immediately, so my immediate thought is, so the bank will go to Maya's business or her house to ask her to pay off the debt. But do you think this is practical? Why? Because usually you take a loan, usually like a mid or longer term, right? So this is not practical. And then, so what else the bank can do? As you just said, they're going to sell the loan to some other bank, right? But now what happens if the other bank you are talking about also only have $100 of cash?
Then you give the loan to Silas and tell him to wait.
So now you see the problem, right? Okay, so basically the problem is, so you see, okay, so we have this small reserve ratio. What is the benefit? You can see, so everyone has money and you can just do your transaction. You can just expand your business. That's a benefit. What is the cost? If you are in an emergency, the smaller the reserve ratio, the bigger the problem. Does it make sense? But clearly, so the bank inherently or intrinsically, so their interest is what? They are trying to lend out or invest as much as they can. Why? Why they want to invest? Why they want to lend out? The more they lend out, the more they invest, more profit. Right? So now you can see there's a tension. But certainly the central bank would like the bank, I mean the commercial bank, has the ability to what? To generate money. Right? So that's how modern economy works. But on the other hand, just okay, so further to help you to further understand this, just imagine we go back to a scenario or the business only accept the cash. How your life is going to differ. Can you have the same lifestyle? There are many things you cannot buy, right? Because now, so say, credit card actually just allows you to consume beforehand. Not even don't mention, I even don't need to go that far, like credit card. Just think about the house you live or your parents live. Just think about the car you drive. Without this money generation, so you cannot consume. Does that make sense? So if people only accept the cash, meaning you have saved enough so that you can consume, right? So all the things you consume today, you have to wait until my age, because I have saved for like 20 or 30 years. Does it make sense? So you can see clearly there is a benefit. We allow the bank to what? To generate money supply. But intrinsically or inherently, we sow the seeds of some problem. Right? So here, just give an example. This kind of literally what happened. Silicon Valley Bank. All right. All right. To further understand that, so let me just close this part, and then so I'm going to explain to you. So, what's the problem in this financial system, and why there are regulations? Right. To close this part, we have this. I think this. Wait a second. Excessive reserve. This is one more thing. So excessive reserve. This is the bank's reserve over and above its required reserve. We already have a quick discussion, right? So no one is going to have excess reserve because it doesn't make any sense for the bank, right? Except under very special circumstance, meaning so there's no investment opportunity, Like Warren Buffett used to keep like hundreds of billions of dollars, right? Okay, so usually so the bank's going to lend out. Now, the other things we have learned from this discussion is we have this multiplier. Sorry, we have this multiplier. Essentially, this is here. Okay, reserve ratio, right? Because first you have $100 that's coming from Silas, and then Silas with Silas deposit, the bank is going to lend out, right? In the early examples of Maya. Now Maya is going to lend, is going to deposit the third bank. The third bank is going to lend out $900. Maya just have, and this process is going to keep going. At the end, the total money supply is going to be equal to 100 divided by reserve ratio. That is just how the commercial bank is going to generate money. But certainly, so this money generating process help us. Again, just imagine if you must pay everything with cash. Can you live in your house you live? No. Can you drive the car you drive? No. Right? Some of us even cannot come to college. Doesn't make sense. So that's how the bank generate money supply, and how this money supply generating process helps each of us. But however, nothing comes with no cost. The cost is here is, so you can see sometimes when there's an emergency, someone need cash. If you don't have enough reserve, and then things is going to fall apart. Right? Okay. Now let's look at this practice question. We have the T account information for a bank. Assume bank has no excess reserve. What is the required reserve ratio? It's 100 divided by 1,000, right? Oh, by the way, here, there's another good example to show you how bank works and where the trouble of Silicon Valley Bank come from. Look at it here. So the bank has deposit, which is their liability. And then they're going to first just set aside a few, which is required reserve. And then they're going to make loans. Just think about Silicon Valley Bank. They're going to make loan to some like startup. What else? What else notice? In this case, the bank put a lot of money in treasury bill. Why? What is treasury bill, by the way? We just talked about in the previous chapter, what is treasury bill?
Short-term bond.
Short-term bond from
Federal government.
federal government, right? So many cases, this is a very safe what? It's a safe haven, right? To deposit their money. All right. So Silicon Valley Bank, what they did is actually they just, because remember 2020, there's a flood of money, suddenly the flow of money, a flood of money, right? And then they have a lot of deposit. In the short term, there's not much. There wasn't much. Usually you may not able to find enough profitable project to invest. And then so they decide to buy a lot of treasury bill. And remember during the crisis, the interest rate was low. And remember, so the price of a treasury bill versus interest rate. If interest rate is low, meaning what? So the price is going to keep rising. So that's profitable for them to buy treasury bill. But suddenly in 2021, 2022, the Federal Reserve Bank reversed the course. The interest rate went up, and the treasury bill becomes the price fall.